So, good evening once again. Today objective today. Hope you can see my screen.
No.
No, you can't
Okay.
access the screen.
So today objectives, which is today is what 10th days 25. So today objective is still under listening, and as I explained yesterday, that we have two methods of computation of listening, and I said number one is traditional approach, and the other one is what? Modern approach. That is modern method. So under traditional approach, when you look at the videos, you will see everything there. We normally compute it by way of when the business is what? When there is what? Investment in a business, then we calculate the NPV. We look at it from the angle of NPV, and also we look at it from the angle of borrow and buy. If you watch my video, you understand everything about leasing, borrow and buy, and also you look at it from the angle of leasing, and also you look at it from the angle of hire purchase. That is traditional. But for modern method or modern approach, all these things that you see, if there's, because sometimes the examiner will not tell you to use traditional method or modern method. But for traditional, when you discover that the examiner start the question with investment, that probably there's investment, or the company is trying to install a new machine. So if the question is playing around the investment, you know that you have to start with NPV. You have to compute what? The NPV, that is in terms of what? Acquisition. So you have to start with what? NPV, followed by borrow and buy, followed by leasing, and followed by hire purchase. Then if it is modern method, if you notice that the question is playing around of what? Around of borrowing. Probably the company is playing, the question is playing around of what? Borrowing, that there's a long-term borrowing, that the question, the examiner is trying to look at the borrow. So that is the modern approach. Then you start with borrowing, you play around, start your computation with what? Borrow and buy. So this borrow and buy, everything that you compute here is the same thing, nothing change. Then listen, then hire purchase, nothing has changed. It's the same thing, just like copy and paste. Then the final one is what? NPV. So this NPV is the one that we used to start here, but here you are computing the NPV last. But the treatment of MPV here will be different. The treatment of MPV under modern approach will be different from the treatment of MPV under traditional approach. That's the only difference. So the rest are same way. The way you compute borrow and buy here is the same way you are doing it here. The way you do your leasing is the same way you are doing it here. The way you do your hire purchase is the same way, but the way you are computing MPV here will be different from the way you are computing it under modern approach. Is it clear?
Yes, it's clear.
Okay. So now please watch the video so that you can get that. So this night, I'm not going to compute borrow and buy. No. I will not compute leasing. No. I will not compute hire purchase because I said the way I did it under traditional approach is the same way. So I'm going to start with MPV because it is only MPV that is what that is different. So modern approach now. So that's what I say. Go and watch the video under traditional method. Then when you watch the video under traditional method, you are going to get it because it's the same way you are doing it under what is it called? Under modern method. So computation. So it is MPV that I want to compute now. Because I said the requirement for that is different here. Computation of what? NPV. Computation of what? MPV. So under modern approach, hello, I believe that you are all with me. Hello.
Sir. Yes, sir. We are with you, sir.
So under modern approach, what you need is that you need the cash profit. When under modern approach and you want to compute MPV, you need cash profit, to form part of your table, and also you need what's it called? Tax payment, tax payment, tax payment on that cash profit. Tax payment on what? On a cash profit. On cash profit. On cash profit. And also you need what's it called? The scrap, what's it called? Lease payment. You also need lease payment. Lease payment. Lease payment. And you also need what is called tax savings on lease payment. Tax savings. Tax savings on what? On lease payment. On lease payment. So these are the things that you need while computing your what? Your MPV under modern approach. These are the things that you need. You need cash profit. You need tax payment on cash profit. You need lease payment, and you also need what? Tax savings on what? On lease payment. Are we there, please?
Yes, sir.
Hello. Okay. So now the requirement we now go by, you say year, particular, cash flow, discount factor, and the present value. So in the question, based on the question that we are working with, I believe that because yesterday I said they should help us to send the question. So for those of you that you don't have the question, you can request for the question. But I believe that they sent it yesterday to the group. So from the question, you look at the number of years given to us in the question, which I believe that what was it called, is from I think it's 5 years. It's 5 years that was given to us from the question. So meaning we have year 1, year 2, year 3, year 4, year 5. So this one will not start with initial outlay, because I told you that it is under traditional approach when we are computing for MPV. That is where you make use of initial outlay, because that one is has to deal with investment. But under modern method, when you are starting with borrowing, then definitely when you are computing for your MPV, you will not start with what? Initial outlay. So that is why I did not start with year zero, because if you watch video under traditional method, you discover that when I'm putting my MPV, I start with year zero, which is initial outlay. But here, nothing like year zero, because I am not doing it based on what? Based on investment. Is it clear? Hello.
Yes, sir. Yes, sir.
Yes, it's clear.
So for particular, you now begin to put it down, because I said you have to start with what? Cash profit. You just write cash profit. Cash profit. So cash profit of year 1. So what is the cash flow of the cash profit of the year 1? That is what you now check from your what? From your question. That is, what is the cash profit from what? From the year 1. Are we together? Hello.
Yes,
Hello.
sir.
Yes.
So from the question, we are told that what's it called? White Malam PLC has decided to install a new mailing machine. The machine cost is 20,000. That's the initial outlay. You can only use this 20,000 for initial outlay when you are using traditional method. But for modern method, you don't need to use it for your what? For your MPV. So let's continue. And it was estimated that it will have a useful life of 5 years. You can see 5 years, and with a trade-in value of 4,000 at the end of the 5th year. That trade-in value represents scrap value. So if you watch the video under traditional method, you understand all those things, because I've explained it there. Additional cash profits. Additional cash profit from the machine would be 8,000 naira per annum for 5 years. So you can see additional cash profit of it, 8,000 naira per annum for 5 years. It means that cash profit. Hello, are you following? Are you
Sir.
following?
Yes, sir.
Okay, cash profit, cash profit, 8,000 naira. It says it is for 5 years. Cash profit, 8,000 naira. Cash profit, 8,000 naira for 5 years. Now, after that, and I say you also need what? tax payment on cash profit. You need what? Tax payment on cash profit. Are you following, please?
Yes,
So
sir.
tax payment
Yes,
on
yes.
cash profit. So you have tax payment on the cash profit. So it means that, let me now explain something to you. You calculate the tax, right, on 8,000. What is the percentage of tax given to us? If you look at the question, they are giving us percentage of tax to be what? 35%. So what is the 35% of 8,000? Hello?
2,800. 2,800.
Hello?
2,800.
Okay. So let me now give you instance of what I want to do. It means that if you calculate 35% of year that as a tax that you want to pay, tax in year 1 will be paid in year 2. That's the meaning. That's how the tax need to be. Tax in year 1 will pay in what? Year 2. Hello?
Hi.
Tax in year 1 will pay when?
Yeah,
Yes,
true.
You will pay in year 2. So tax in year 2 will pay when?
Year
year
3.
3.
Year 3. Don't forget it's the same amount because it is 8,000. Yeah, you know it is 8,000 for all of them. Hello?
Hi.
I said it is 8,000 for all of them, right?
Yes, yes.
That means they are paying the same tax. So tax of year 3 we will pay when?
You be in year
Yeah,
4.
4.
Year 4. Tax of year 4 we will pay when?
Yeah, 5.
Year 5. Tax of year 5 we will pay
Yes,
when?
6.
Yes.
Yes,
Year
6.
6. It means that tax of year 1 we will pay in year 2. Tax of year 2 we pay in year 3. Tax of year 3 we pay in year 4. Tax of year 4 we pay in year 5. Tax of year 5 will not be paying year
Yes, sir.
6. It means that if I want to put the number of years, I will say from 2 to 6 years. So it is 2,800 as outflow. It is not inflow because tax is what you are paying out. So you have to bracket it as what? Outflow. So you can see that instead of me to be putting 2, 3, 4, 5, 6, it's not making sense because so far the value is still the same amount. Do you get my point? I would
Yes.
rather cover it. I would rather do it together to say 2 to 6 years, 2,800. Hope it's clear. If it is not clear, let me know so that I can explain again.
Explain.
Others, is it clear?
Recap.
Hello? Hello? Hello?
Hi, sir.
I hope it's clear. Others, I want to move on, please.
I said
Yes,
you should
sir.
recap.
Okay, and that's why I said I didn't get that part. That's why so what I'm saying is, let us assume you have a profit, a cash profit of 8,000 in year 1, and you want to pay tax based on the question 35%. So when you pay 35% of that 8,000 in year 1, then when you are paying it, when you calculate it in year 1, you have to pay the profit that you make in year 1. You pay tax on it in year 2. That is the following year.
Okay,
The
so
profit,
the 2 to 6, sorry, applies to just the tax alone, right?
yes.
Are we not going to add all the 2008 together from year 2 to 6?
You don't need to add, right? You don't need to add because it's still the same thing. I've already said it is 2 to 6 years. If I want to do it separate, that's the meaning. I can say, instead of doing it like this, instead of doing it, I can say 2, 3, 4, 5, 6. I will now put 28, 28, 28, 28. Do you get my point now? So at this junction, no need of adding. You have already tell us that this 2006, it is from 2 to 6 years. That's the meaning. So this cash profit that you see that I separate as 8,000, 8,000, 8,000, I can also say 1 to 5 like this. Do you get it? I can also say 1 to 5 and I will put just 8,000. I'm only trying to explain the grammar that they said 8,000 naira per annum for 5 years. That is why I splitted it like this: 1, 2, 3, 4, 5. Then assuming I want to shorten my work, I will just say 1 to 5. Cash profit 8,000. Is it clear?
Yes.
Others. Can I move on, please?
Go ahead, please. Go ahead.
Hope is clear. Hope no issue.
Okay, sir.
Now, after that, I said you also need lease payment. Lease payment simply means your initial deposit. That if you want to lease the asset, what is the initial deposit of that asset? So let's read the question and look at how much is the initial deposit. From the question, they said 3 methods of financing have been considered. A, purchase the machine for cash. That one is not lease. B, they said lease the machine under an agreement which would entail payment of 4,800 at the end of each year for the next 5 years. Can you see that one also? That is your lease payment. Hope it's clear now. Lease payment, 1 to 5 years. Lease payment. Can you see now? Because they say for the 5 years. So instead of me to write, so that the table will not be too long. Instead of me to write 1, 2, 3, 4, 5, are you getting now? Just say 4,800. So it is outflow because you are the one paying that lease. You pay. Is it clear? Before I move on.
It's clear.
It's clear. It's clear.
Okay. So then, others. It's only one person that said it's clear. Oh, others. Should I move on?
Yes.
Move on. Move on. Yes.
Okay. So the last one is that what? You have to also put tax savings on lease payment. Tax savings on lease payment. So tax savings on this lease payment. So let's look at the question, what they gave us about the tax savings on lease payment. So let's go to C. Purchase the machine under hire purchase agreement. This will require an initial deposit of what? 6,500. That one is hire purchase, okay? And payment of 4,400 per annum at the end of each year for the next. They now tell the interest part of the payment for the tax purpose. So all those information that we read now is for hire purchase. So lease payment now. So this is 4,008. Then what is the tax on that lease payment? What is the tax given to us? 35%. So if you calculate 35% of 4,008, what do you have? Because the tax is 35%, and we want to get the tax savings on the lease payment. Tax savings on lease payment.
1,680.
2,000 what?
1,680.
1,680.
So now it's still the same thing now. Let's now check it. Please, one person should move. If you charge tax in year 1, you know they say 1 to 5 years. The tax that you charge in year 1 will be paid in year 2, which is 1,680. You know all these things is 1 to 5. The one you charge in year 2, the one you charge in year 1 will be paid in year 2, right? The one you charge in year 2 will be paid in year 3, right? The one you charge in year 3 will be paid in year 4. The one you charge in year 4 will be paid in year 5. The one you charge in year 5 will be paid in year 6 because it is 1 to 5. So definitely year 1 you pay it in year 2. Year 2 we pay it in year 3. Year 3 you pay in year 4. Year 4 you pay in year 5. Year 5 you pay in year. So how many years is now covered now? It is 2 to what? 2 to 6. Which is 1,680. Then it is outflow because you are paying tax. Is it clear? Hello?
Sorry, sir.
Yes, sir.
That 1,680 be clear, sir.
Is that?
That 1,680 from the tax.
What is the percentage of tax?
The percentage they gave us is come, sir.
Is 35%. It's 35%. So
Yes.
then 35% of lease payment, because I said tax savings on lease payment. So 35% of 4,008.
Okay. All right. Got him. Thank you.
So that's all. Then we now move to discount factor. So your MPV, the discount factor given to you is in the question. I think they gave us the weighted average cost of capital. The company weighted average cost of capital, it is what? 12% after that. So at 12%. So then year 1, you can compute it, and I believe that you still remember the formula. 1 plus R raised to power minus N. So that's how you get your discount factor for a single year like this. 1 plus R raised to power minus. So 1 plus R, your R is 12%, which is 0.12. Close the bracket and raised to power minus 1 because you want to do year 1. If you want to do year 2, you just turn it to 2. If you want to do year 3, turn it to 3. Up to year 5, then we now move to the next one. So what do you have in year 1? Hello?
0.892.
893.
0.893. Okay. So year 2.
0.79.
0.79.
7.
Okay.
797.
Year 3.
0.711.
0.711. Okay. Others should confirm unless the approximation
It's
is
okay.
huh?
0.636. It's okay.
Next one.
0.636.
636. Okay, year 5.
0.567.
0.567.
Yes.
567. Now, you now pause. The way you are going to compute 2 to 6 is different. What you do when you are computing something like this, you will use cumulative discount factor. That is, CDF will be equal to 1 minus open bracket 1 plus R, close it, raised to power minus N, then everything over R. So what you are going to do is that you first of all calculate 1, because you know when they say 2 to 6, it means that there's 1 here before you move to 2. Yes or no? Because you say 2 to 6, it means that there's 1 before it. So you have to compute for 1. When you are computing for 1, you are using a single one, as in this one. You can use it to compute for 1 because it's not cumulative, it's just 1. So when you compute for 1, whatever you get, you will now put it separately. Whatever you get for 1, put it separate, keep it. Then you will now compute for cumulative of 1 to 6. Hello, are you with me?
Yes.
You now compute for cumulative of 1 to 6. You are using this formula to do 1 to 6. So when you now do 1 to 6, keep it somewhere. That one that you did before, that one that you first did, remove it from the 1 to 6. Whatever you get, it is 2 to 6. I believe it's clear. Hello.
Please recap it. Please recap that.
You know, if I said 2 to 6, it means that there's 1 here now before I can say 2. You know, when they say 2
Yes.
to 6, it means that there will be 1 before 2.
Yes.
Then, first of all, compute for 1. Use this formula to compute for 1 because it's a single one. Compute for 1. Whatever you get, write it here as answer. Right? You now compute for 1 to 6 again, but you are using cumulative. You are using this formula to do 1 to 6. You are using this formula to do 1 to 6. You are using this formula to do 1 to 6. Whatever you get, write it. You now subtract it from the 2. You subtract this one that you got from this 1 to 6. Whatever you get, it is your 2 to 6. Is it clear now?
Yes.
3.219. Another person should please confirm.
Is it final answer? So let us do it separately so that.
It's final answer.
So let's do it separately. Give me your computation for 1.
0.892.
So when you compute for just year 1, year 1, it is
0.893.
what?
0.893.
893. When you now compute for year 1 to 6, so that one is when you are using cumulative. What do you have?
4.111.
4.111. You now subtract it. So whatever you get is your 2 to 6. So what do you have? What do you have, please?
3.218.
3.218. After 8, what do you have?
Nothing.
Okay, this is the final something, okay?
Yes.
So 3.218. Then you do the same thing to 1 to 5, but 1 to 5, because nothing is here under 1 to 5, it is 0. Do you get my point now? So you just do 1 to 5 cumulative. Just do cumulative of 1 to 5. Because 1 to 5, nothing is before 1, it is just 0. So do cumulative of 1 to 5. So cumulative of 1 to 5.
605.
Use that formula for cumulative of 1 to 5. What do you have?
3.605.
3.605. Others, you can also do your own. 3.605. Then 2 to 6. Okay, we've done 2 to 6 before. Just repeat it. 3.218 because we've done it before. And it's the same rate. Any question, please? Any question?
Please, let's see the something.
Which part?
Which part?
This 2 to 1. 2 to 6. 3.2.
Can we move on?
Can we move on?
Yes, please.
Yes, please.
So
So
then we can now move
then we can
to
now move to
present value.
present value.
So the present
The
value
present value
will be your
will be your
cash flow
cash flow
multiplied by discount
multiplied
factor.
by discount factor.
That is 8,000
That
times
is
this.
8,000 times this.
So cash flow multiplied by
So cash
discount
flow
factor.
multiplied.
So what do you have, please? What do you have? Oh,
For year one, 7,144.
so this one is tax savings. It's an inflow here. Sorry. Because this you save it. Tax savings. Tax savings. That is your savings. So it's an inflow. So what do you have?
7,144.
7,144. Okay. Follow by what? 8,000 times 0.797.
6,376.
6,376. Followed by what?
5,688.
5,688. Followed by what?
5,088.
5088. 5088. Okay. Followed by what?
4536.
4536. Followed by what?
9,010.
9,010. Like this.
Yes,
Followed
minus.
by what?
Minus nil.
So it will be in bracket because of this bracket. Okay.
17,304 minus as well.
17,304. Okay, followed by what?
5,406.
5,406.
406.
So then you can cast it to get your MPV. So from there, we can now comment on what to do.
$7,924 positive.
7,924.
Somebody else should please confirm.
7,924. Order to check. So now decision. If you look at our traditional approach, what we arrive at our MPV is lower than this. So as a result of that, modern method, you can check. I think what we arrive when we do traditional approach is lower than the modern. So modern method is considered better than traditional approach because it gives highest MPV of 7,924. Then that is the A part requirement. So B part, which one to be considered as the least cost? I think it's a leasing. When we do, I said it is only MPV that is different. The way you compute for leasing, hire purchase, borrow and buy is the same way. So when we do our traditional approach, borrow and buy, leasing and hire purchase, which one we consider to be cheapest finance option? I think it's a lease the machine. Right? The cheapest finance option. You can okay. The cheapest finance option is to lease the machine. Because when we do traditional approach, it is the leasing that is cheapest based on our computation. So if you watch the video, you understand it. So C part, we say what are the other matters that need to be considered before we can say we want to do what? What's it called? Based on the question. So what other matters we need to be considered before finally deciding which method of financing should be adopted? And our previous class of traditional approach, we say we are going to look at it from the angle of our running costs. That is the running expense, right?
Yes.
Running expenses. It's just like I'm trying to do copy and paste again from what I did earlier on. Still the same thing. And we also said we are going to look at what's it called? Effect of cash flow. If you look at that traditional approach, this is what I put. Effect on the what? On the cash flow. Cash flow. I also said we are going to look what's it called? The scrap value, that is trading value. The scrap value. What again? Okay, I said we are going to look at it from the angle of effect of reported profit. Okay, reported profit. We are going to look at the reported profit. So the profit that you report before you choose the what? The option. What's it called? Other matters based on the question before you can what other matter we should be what consider before we can finally deciding which method of finance should be adopted. So you can look around. So you have to consider before you can say okay, you are choosing this option. You first of all look at the running expenses, effect on the cash flow, scrap value, reported profit, and I think I put one again. Alternative of what? Alternative of fund, source of fund. Alternative of what? Fund, that is what are the alternative way of getting fund, alternative use of fund, alternative what use of fund. Okay, alternate use of what? Use of fund. Use of fund. So these are the things that you need to consider first before you can decide which option to be taken. So that's all for modern approach. So I said, based on my explanation, all these things are relevant to compute under modern approach, just that we've done it under traditional, and there's no difference. It is only MPV that is different, because under traditional approach, if you want to calculate MPV, you need what's it called? Initial outlay. You need initial outlay. You need what's it called? Cash profit. You need tax, savings, and that's what I said you need when you are computing for what? Computing for NPV under which method? Under traditional approach. That is, you need what? Initial outlay. You need the what's it called? Tax. You also need the tax savings on the capital allowance. You need scrap value. If you remember, these are the things that I explained, that you need initial outlay, you need cash profit, you also need what's it called? You need the tax on the tax profits after you will have deduct your what? Your capital allowance, because there is a cash profit. Then you have capital allowance. After you remove your capital allowance, then you can have your taxable profit. Then you can now get your tax on that taxable profit. Then what again? You also need what is called scrap value. So after that, you can get your MPV. So when you now look at the modern approach, you discover that what we need under modern approach, it is quite different from the traditional approach. Under modern approach, we need cash profit, we need tax payment on cash profit, and we also need lease payment, and we also need tax savings on lease payment. So that's all. So any question?
Calculations. So